Welcome to our in-depth exploration of real options in finance. Today, we'll delve into what real options are, why they matter, and how they can be applied using real-world examples. By the end of this video, you'll have a strong grasp of how to utilize real options to make more informed strategic decisions. Real options are financial concepts that give a business the right, but not the obligation, to make certain business decisions, such as deferring, expanding, contracting, or abandoning a project. Much like financial options, these choices add flexibility and strategic value to decision-making processes. Let's consider an example to help clarify. Suppose a technology company is considering investing in a new product. By treating the investment as a real option, the company can defer the decision until more information is available. If market conditions become favorable, they exercise the option to invest. If not, they can decide against it, minimizing their risk exposure. A key type of real option is the option to defer. This allows a company to wait until uncertainties are resolved before making a large investment. For example, a mining company might wait until commodity prices are high before beginning to extract resources. Consider a pharmaceutical company with the option to defer on a new drug. Instead of running all clinical trials at once, they could wait for preliminary trial results to reduce the risk of a failed full-scale launch. Another type of real option is the option to expand. This option can be particularly useful if the initial investment is successful, providing the ability to increase production or scale the project. Imagine a renewable energy company that has successfully launched a pilot wind farm. By retaining the option to expand, they can increase their infrastructure as needed, based on the pilot's success. The option to contract is another useful strategy. When market conditions become unfavorable, it allows a business to reduce its scale or operations to minimize losses. For instance, a retail chain operating multiple stores might decide to shut down less profitable locations during an economic downturn, thereby contracting operations to focus on more lucrative outlets. Then there's the option to abandon, which allows a company to completely halt a failing project, cutting further losses. Consider a startup that realizes their new app isn't achieving user adoption. They might decide to abandon the project to allocate resources better elsewhere. Real options can be valued using techniques similar to those used for financial options, such as the Black-Scholes model or binomial models. These methods consider the volatility of the underlying asset, the time to expiration of the option, and other factors. Let's look at an example of a binomial model to value a real option. Suppose a company has a project that costs $1 million today, which can yield $2 million or $0 in 1 year. The up and down probabilities are 50% each. Using the binomial model, we can quantify the project's real option value. To better understand real options in a dynamic business environment, let's consider a multi-stage investment in R&D for a tech company. Stage 1 involves an initial investment, and if successful, leads to stage 2 and 3 expansions. By integrating real options, the company can strategically decide at each stage. It's essential to gather data for informed decision-making. Consider the historical volatility of similar projects, market trends, and the strategic importance of flexibility. Conduct scenario analysis to understand the potential outcomes multiple real option scenarios may provide. Now, let's address some frequently asked questions about real options. Question 1. How does a real option differ from a financial option? Answer. A financial option is a contract that grants the right but not the obligation to buy or sell a financial asset at a specified price before a specified date. A real option, on the other hand, pertains to physical, non-financial assets and offers similar flexibility in making business decisions. Question 2. What industries benefit most from real options? Answer. Industries with high levels of uncertainty and significant investment opportunities benefit most from real options. These industries include technology, pharmaceuticals, energy, and large-scale infrastructure projects. To conclude, real options provide a robust framework for making strategic decisions in environments filled with uncertainty. By considering the flexibility and strategic value embedded in these options, businesses can navigate more effectively toward their goals. Thank you for joining us on this journey through real options in finance. Remember to like, share, and subscribe for more insightful content. Leave your comments and questions below, and we'll see you in the next video.